agreed on your sales, you done your invoice, and you are getting an LC for your shipment, or you're opening an LC if you're buying something, and you have taken care of everything, and you assume there is no more risk. But there is a risk, which if one would be the currency. The issue in international trade, if you are working if you are working in the Eurozone, for example, or which obviously, although you're selling from one country to another country, but you're using the same currency. So there is no currency exchange rate risk. But in many cases, when you are selling from one territory with one currency into another territory with a different currency, and the currency against each other are fluctuating, there is a risk. Your cost, your expenditure usually is based on your local currency. So if you sell the product, which locally, let's say, is costing us in sterling, to America, which obviously is in dollars. Now, if you price the product in sterling, we are safe. You say, I want £100, £100,000 or whatever for this service or product. And whenever it's ready, the LC is payable, I get paid, I'm safe. But the problem then is shifted to the importer, to the buyer of the product, which is he is going to sell it, or she is going to sell it in a country, that's in the United States, in dollars. And maybe today's exchange rate is $1.50 to a pound, but at the time when the transaction is complete and the goods have arrived in the United States, this exchange rate can be different. In favor of either party doesn't make any difference, but there is a risk, which if I have priced in sterling, I've shifted the risk to the buyer. And if I'm accepted to sell it in dollar, I have taken the risk of the exchange rate fluctuations. Now, the way you're gonna address the FX risk and manage it is not to make money out of it. We are not there to try to make money out of the exchange rate in our favor. But what we want to do, we want to make the risk as low as possible, spread it. Now, the ways you do it, best way is actually price it in your local currency and ask to be paid or LC open in that currency. So the risk is all shifted to the other party. Now, assuming the other party does not accept it, they say, look, I want to pay in dollars, in their currency. And to get the contract, you may say, okay, I would price it in dollars. But how do you make sure that at the time of the payment, 3 months, 6 months later, whenever the goods are shipped and you can go and get that money, your assumption of whatever exchange rate was today, it's not going to be the same, most likely. It has shifted, either in your favor or against you. The problem is when it goes against you, and you get less than that £100,000 you were expecting. Now, a number of things you can do about it. First, you can go and say, look, I'm going to receive £100,000 in 6 months' time in dollars, which is, let's say, today's exchange rate is $150,000. So what you do, you go to your broker, your bank has got a broker, and say, look, I want to buy a future exchange of $150,000 to pounds. Give me exchange rate fixed today, delivery in 6 months' time. That means the actual contract would happen in 6 months' time, but I want to fix the exchange rate today. So you are buying a forward contract, dollar to sterling, because you're going to be paid in dollar. You want to convert it to sterling at a fixed rate. That's a future contract, which the bank would say, okay, fixed, that's the exchange rate, and they would ask you to pay a deposit against it, usually around 10%, and the rest to be paid nearer to the time. Obviously there is, usually the terms are, if the exchange rate goes against you, you would pay a bit towards them, and you balance that, keep that 10% balance. That's a fixed future contract. It needs more money to finance it. Let's say you don't have that sort of money. You already have to produce these goods, so you don't have more money to go and 10% of it in the bank. You can go and hedge it, buy an option. But the difference with the option and the future currency contract is that in a future currency contract, you're actually buying that currency or selling that currency, which has got a date for it to happen, but it's gonna happen. With option has got a period. In that period, you got an option to exchange, buy or sell, depends is put or call option, a certain currency, and for that option you have paid a small amount of money, which you can execute it or not. If you don't execute, you lose that money. If you execute it, obviously you only do it if it's in your favor. It's a hedging which would secure your losses to a minimum amount. So that's what we call a option or hedging against the fluctuation. We see the slides. We've gone through FX options as well. Now, that's the best you can do with the foreign currency. Do I need to do it? You can ask yourself, do I really need to do this? It really depends on the size of the contract. Let's say we were talking about pounds to dollars, and think if most of my raw material or input in the product I'm selling maybe coming from America, or maybe based on commodities which are internationally priced in dollar. So my exposure to exchange rate is not that much, because if the price of the goods I'm inputting into it is in dollars as well. So I'm not that much worse off. It's only a bit of value added I'm producing in this country. So, or maybe the company is so big and trading around the world in multiple currencies. It's like, having a basket of currency and say, look, they will hedge it, they will balance each other. So I don't need to be bothered with this hedging business all the time. So it comes to very specific circumstances which you decide how to go about it. The next step within the international trade and reducing the risk is the guarantees you can have. Now, why do I need a guarantee? What's a bank guarantee? Bank guarantee represent an irrevocable obligation of the bank to pay a specific and a specified amount of money if the party which the bank is giving the guarantee does not fulfill its contractual obligation. What does it mean? Now, let's say I'm buying certain machinery from you, and for $1 million, simple figure to use, and you are saying you're going to deliver it in, let's say, 9 months' time. We agree on all terms. I go and open an LC. Opening an LC costs me probably 1 to 1.5% at least, which can be $150,000 in this case. And what happens if you don't fulfill your obligation? The goods are not ready, or for whatever reason you are not going to supply it. Yes, I haven't lost my money. $1 million, I can take it back because it is within my bank, and you haven't satisfied the LC requirements, and I get my money back. But what about my cost, my waiting, my lost opportunities? So you will say, look, I open an LC for $1 million, but you have to open a bank guarantee that if you don't fulfill your obligation, I can get that money to cover my costs. So that's a very simple bank guarantee. There are bank guarantees for many other reasons, like if you are going into a tender, you're submitting tender documents. So let's say a government in certain part of the world has say we are buying certain supplies, and asking for people to come and submit tenders. Now, usually in these situations, because you're going to go and say, I would produce it at a certain price, lower price, and whatever, and you win the tender. And after you have won and everybody else is gone, then you can come, oh, sorry, I can't really do it at this price, I need a bit more. Now, it doesn't work like that, because in most tender situations, the government would ask the people who are tendering to put a tender guarantee. A tender guarantee says, like, if you did win the tender based on the terms you submitted, and you do not fulfill the terms, deliver it with those terms, you lose your money. So you cannot go and talk, in a way that you cannot support it with action. There is another one called performance guarantee. Again, let's go back to that contract of machinery. I've bought the machinery in situation that you have promised these machines would perform in certain situation with a certain capability and quality. Now, I've paid for it, but I want a performance guarantee. That means usually around 4, 5% or 6% of the total value. But what it is that you come and get these machines to work, and you make sure that it is working as stipulated in the contract. And if it's not, I can go and get the bank to pay me the performance guarantee. And if it's working, I give your guarantee back to you. It just so you release the money from your bank. That's a performance guarantee. Advance payment guarantee. Advance payment guarantee in many cases, like we agree on it, all the terms, and I'm going to go and now build this machinery or equipment or purchase the materials you want, but I need a payment in advance. I cannot finance it myself, and I don't have the cash to finance it. So what you would ask is, I would pay you in advance, but I need an advance payment guarantee. That means if you cannot deliver, I get my money back. Now, you would ask, how can I give an advance payment guarantee? If I had the money, why don't I go and just do it and do a normal trade? Now, it's very simple. You, as a factory, you have got a lot of collaterals, your buildings, your machineries, your land, which you can go to the bank and ask the bank, your bank, because your bank is a local bank and knows all about you, to issue a payment guarantee for you. And based on your collateral, the bank would issue the payment guarantee. So you don't need to actually push any cash in there. And then the buyer would be happy and knows it's going to be, anything goes wrong, you're going to get his money back. And you say, okay, this is the money, go and start manufacturing or buying or purchasing or whatever you're supposed to do. So that's another way of having the security for the payment in advance. Remember, you need cash to get cash flow to get all these things moving. So most of these instruments are used to enable parties to create financing to get the trade going forward. Now, I think we had enough now. I see you in a minute talking about the trade finance products.